Hello, everyone. I'm Peter Lemieux. I just want to set up one thing in front of you to see if I can get this to work. There we go. That's me in the little box. I wonder if I can move that. Nope. Why don't I do this? And they'll go pull that up when I'm ready. Welcome to class, everyone. My name's Peter Lemieux. I'm with the insurance exam queen, Melissa Dillon. I've been helping Melissa teach students for many, many years before she was the queen. And we've become good friends, and I help her out. Today, I'm here to do a live class on life insurance policies. Now, I guess the way we do this is you guys communicate to me through the chat box. So I have a question for you before I begin. I'm going to hold up a whiteboard, and I want you to tell me if you can read the word. You know how we have these mirrors, or is it backwards? So in the chat box, please tell me if you could read that word. Yes. It wasn't inside out. I think technologically it's going to work. Now, the only thing we got to find out is, will the teacher work? And we'll never know until we get started. As I said, my name's Peter Lemieux. I have been selling insurance for, you all sitting down for this one? 51 years. Yes, I did start when I was 3 years old. So that's the truth. One of many truths I will be telling you today. Today's topic is life insurance policies. It's one chapter as you get ready for your exam. What I want to do today is kind of simplify it, make it make some sense. I don't want to go into great details where you have to take copious notes, although I do want you taking notes. Please take notes so you have something to refer to. What I want to do is clarify what this whole game of life insurance policies is about. And the way I want to do that is I really want to focus on 3 policies. At the end, I'll tell you how the other ones fit in, but 3 policies really drive this chapter, okay? And we're going to do that. We're going to start with term insurance. We're going to move to whole life. And then I want to spend a little bit of time on universal life. From that, I'll teach the other ones toward the end. What I need from you people is, if you're going to be helped by this class, to please take notes for yourself. I need you to communicate to me through the chat box. And I do my best to answer all the questions in the chat box, although I do confess sometimes I get a little bit carried away with what I'm saying and I don't look over there and I might miss a question or two. You can ask it a second time. I just want to answer your questions. But let's see if we can make sense of life insurance policies. I did prepare a few slides, so I'm going to go to a slideshow. You'll see me. I'll be in a little box down at the bottom as I talk about this. But like I said, I want to talk about term, whole life, and universal life, and then from that, build how these policies work. So before I begin, term insurance is the simplest, in some ways, the most pure form of life insurance. You pay in. When you die, the insurance company pays out. I've often told my own clients, when you buy a term policy, you are buying a 2 clause policy. You live, you pay. You die, we pay. That's it. You now understand term insurance. No frills. Okay? That's what term insurance is meant to be, a no frills policy. Before I go to the slides, to understand any insurance, you must understand this. The insurance company collects money into a pool, and from that pool, they pay out the claims. They have to have some intense knowledge of the number of deaths to expect so that they can charge a proper rate. So what happens, this is really a simple concept, but people get it I don't think they get mixed up. They don't think about it. The age of the insured changes the amount the insurance company has to collect. The amount of people who die when they're 10 is pretty small. The amount of people who die when they're 70 is a much higher percentage of the 70-year-olds that are alive. You see, I hope this makes some sense. I'd like to draw this, but just so. In the beginning, we have a whole bunch of people get born. And as that group of people age, people start dying. So the number starts to shrink. But the percentage of people that die increases. So you have an increasing top number, the people dying, a decreasing denominator, which is the number of people who are alive. And that means the amount the insurance company needs gets larger as we age. Simply spoken, 70-year-olds pay more than 20-year-olds. So you have to understand that concept. As we age, the amount the insurance company needs to insure us increases. Now, that works in all of our calculations. It's kind of a simple concept. You know, the older we get, the percentage of people our age that are dying gets larger. Okay. Now, that was kind of boring. Peter, I got other things to do. Let's try to make a little bit more sense of this in questions you'll get on the exam. Okay. So now I'm going to bring up my slides. There we are. Life insurance policies with Peter at the bottom. I may switch back and forth a little bit as I make my concepts here, but let's change the slides. Oh, I can't do that. Easy for me to say. If you people ever want to contact me, that's how you find me. So you can take a picture of that if you want, but if you just want to write me a question or something like that, or you have any requests, that's how you find me. All right, now, the problem with this is I can't see your chat box when I do that. Be patient with me, folks. Term insurance, 2-clause policy. You, the insured, live, you get to pay again. If you die, the insurance company pays, okay? Unfortunately, for me to change the slides, I got to take over to another screen. One basic concept of term insurance is it only lasts for a specific amount of time, and then it ends. For that reason, you want to connect T's. Term is temporary. You buy it for a specific amount of time, and then it ends. Term insurance is the lowest cost policy. It's age rated, which I already explained to you. The price increases as people get older. So, example of rates. We have here what's called an annual renewable term. My friends, when you get words on your test, don't freak out. This explains exactly how the policy works. Every year, the policy will renew, which means it will get a new rate. So in an annual renewable term, your rates go up every year. Now, as I go on, I think we're going to make a lot of sense of this. Term insurance, oops, wrong slide. We already did that. How's this one? Here's example of rates. You can buy term insurance for a block of time. If you buy a 10-year level term, meaning the death benefit and the premium stay the same for 10 years, that means your rates are going to stay the same for 10 years. What happens in the 11th year? That policy ends. You bought a 10-year term policy, it ends. I'm going to say more about that. If that's unsatisfactory to you, you can buy a longer term. If you have young children and you want to raise them until they get out of high school, you might prefer a 20-year level term. What we mean by that is your rates won't change for 20 years, and then the policy will end. So I have a question. Which policy do you think would cost more today? A 10-year level term or a 20-year level term? It's just a couple of friends here having a little drink of ice water. What do you think? Which one's going to cost more? This is where you get to have the great joy of answering my questions. You don't get kicked out of class for getting it wrong. All right, thank you, Katie. You think the 10-year term costs more. Erica says the 10-year term costs more. All right, the answer is 20 years costs more. Now, let me explain why. Getting it right or wrong doesn't make any difference if you don't understand why. In the 10-year term, the insurance company is going to collect money for 10 years and then get rid of you. If you die after 10 years, that doesn't bother them. But when you ask them to commit for 20 years, you're asking them to make a bigger commitment. That there's a better chance that you're going to die over 20 years than 10. So if there's a bigger risk to the insurance company, they're going to charge you more. Plus the fact they cannot change your rates. So we can charge you $100, just forget the numbers, for a 10-year term. But if you want the same death benefit on a 20-year term, it might be $150. Forget the numbers. You're going to pay more if you want to secure your rates for a longer period of time. All right? So having said that, let's see what the next slide says. Rates stay the same for 20 years. Types of term policies. You can have a term policy where your death benefit stays the same for the amount of years you bought it for. 1 year, 5 year, 10 years, 20 years, whatever. You can have decreasing term. When we have this, we are talking about your death benefit decreasing, not your premiums. You're going to pay the same amount for the whole time of decreasing term, but your death benefit will be coming down. We use this to cover debts like a mortgage. You owe so much today, 10 years from now, you're not going to owe as much. We can be lowering your death benefits down to match what you owe in the mortgage. Since your death benefits decrease, a decreasing term will cost you less than a level term. Why? Because you're not buying as much insurance. That level term, you're insured for a certain amount and it stays the same. But in a decreasing term, the obligation of the insurance company gets lower. They're not going to have to charge you as much. The third type of term insurance is you can buy an increasing term benefit, which every year the amount you're covered for goes up. Of course, that's going to require more payment than a level term. You cannot make this note, please. You cannot buy an increasing term policy on its own. It can only be purchased as a rider or an addition on your policy. Now, think about this. This is how people buy inflation guard. You say, I bought a $100,000 policy, but what if I don't die for 20 years? It won't be worth as much. I can put on an inflation guard on my policy, which is quite simply buying you increasing term every year to keep up with inflation so that when you die, you have more insurance. You accomplish that by buying increasing term on top of your policy. So, those are the three types of death benefit that happen in term insurance. Now, question: which policy cost the most this year? An annual renewable term, a 10-year term, or a 20-year term? Class, which is going to cost you the most today? I think I just asked this question in another way. I just added a new policy. Brian, what's the answer? VL, Shanoy, J. No. Cost the most. VL Davis, you got this right 3 minutes ago. The one that covers you for the longest period of time at the same rate will be most. So in this example, the 20-year term is going to be the most expensive. The least expensive is the 1-year term. Why? Because in year 2, the insurance company can jack your rate up. Okay? In the 10-year term, if you want to keep it in the 11th year, they're going to get more money from you in the 11th year. They can't do that in a 20-year term, so they're going to start you off at a higher position. This is a concept to get your term questions right on the test, my dear friends. The longer you buy your term policy, the more you will pay today. Okay? So please remember that. 20-year term is the most. Which policy will cost the least today? Am I starting to make some sense here? Peter, I don't have much money. I need $1 million of insurance. What's my least expensive buy today? You're only asking about today. Annual renewable term, dirt cheapest. But you need to understand when you buy that, next year, your rate will go up. Remember that 20-year term is the most expensive? If you bought 1-year terms, by the time you got to like year 11, you would be paying more than the 20-year term guy. It's going to go up and up and up and up. Okay. In the end, the insurance company collects the same amount of money. Okay. It's just, are they going to increase your rates or not? But if you want to know what it is today, most expensive 20-year term, least expensive 1-year term. Now, a little bit of a review. Term insurance, T to T, temporary. It has the lowest cost for the highest protection. So when you get a test question that says Charlie Smith needs a lot of insurance and he has limited finances, that's code for get term insurance, right? We just need a lot today. And do you remember, you guys are all younger than me, and it's probably a story only I know. There was this children's story about this town that was below sea level, and so they had a dam around the town to protect the people. And a leak came in the dam. And as the story goes, a little boy goes over, sticks his thumb in the dam. Now, is that going to work forever? No, but it worked for that time, for giving the people time to go and repair it. That's what term insurance is like. Look at this is not going to work until I'm 100 years old. Before the time for this time being, it gives me the protection that I can afford. That's really a picture of term insurance. Sorry for my old examples, but when you're old like me, we have old examples. Now, these are words, term insurance. Write these down. You got to know these, my friends. Renewable. If I have a policy that's renewable and it runs out, the insurance company allows me to keep it at a higher rate, no health questions asked. So that annual renewable term says every year my rate goes up, but you don't have to worry about being canceled. As long as you're willing to pay the higher rate, you can keep the policy. You can get a renewable on any policy. If I bought a 10-year term, those rates are set for 10 years. But in year 11, I decide, I still need some insurance. I can keep that death benefit, but now I'm going to, if I bought that when I was 30 and it goes away when I'm 40 and I want to renew it, I will pay the rates of a 40-year-old, which is more than the 30-year-old, but I can keep the policy. Why? Because it's renewable. The insurance company guarantees I can renew it. Truthfully, most term insurance is not renewable, usually past age 65. So term insurance is really designed to give us the most protection when we're making the least amount of money during our working lifetime, okay? It's not designed to protect us if they live as long as Peter's lived for the rest of your life. Am I making any sense, or is this just some old dude talking into his computer and not making any sense? Are we okay? Somebody give me a thumbs up in the chat box because I'm very insecure. Thank you, Faith. May God bless you. There's another word we need to know besides renewable. It's convertible. So again, let's make sense of convertible. I think most, guys, you guys are giving me a big head. I'm going to ask Melissa for a raise. Okay. Most of us know what the word convert means. It means to change. If I change my religion, they would say I converted, right? Same thing in insurance. If I want to convert a policy, I'm changing from term to my next policy I'm going to talk about, whole life. If you have a convertible clause in your policy, you can make that change without any health questions asked. Convertible means you can just change this to whole life. You will pay your attained age. If I bought it at 30 and you want to convert at 40, you'll buy it as a 40-year-old. But what's good about that? What if I have become uninsurable? What if I have stage 4 cancer? At stage 4 cancer, no insurance company is going to touch me. But if I have a convertible feature on my term, I can change it to whole life and be covered until the day I die at a fixed rate. It'll be higher, but it's a fixed rate. Okay. You must know what a renewable clause is and what a convertible clause is. They don't come on every term policy. I love to sell term policies with both those features in it because we don't know what the future holds. Okay. You can buy it with or without them. Obviously, each time you add a feature to your policy, price goes up a little bit. But please know what it means to have a renewable term or a convertible term, or both. You could have them both. All right. Now we're going to change the rule. Going to take everything I knew about term insurance and put it in a drawer over here. Please remember renewable and convertible and know which policy is more expensive than another. Because that could be a very simple question on your test. Which is going to cost the least today? Which is going to cost the most today? Don't forget that little exercise we did. Could be on the test. It also shows that you understand how insurance works, which, as I told you at the beginning of class, the older you are, the more you got to fork over to get your insurance. So understand that if I'm renewable policy or buying right now, if I'm going to make the insurance cover me for 20 years, I got to pay them more than if they can get rid of me after one. Okay? Now, we're going to change topics. Let's just imagine that we're just inventing insurance and we got this term stuff that people can buy. Obviously, some consumers are going to say, this is a problem. In my family, everybody lives into their 90s. Okay? Unless they get hit by a train, they live a long time, and your policy is going to expense me out. There's going to be an age 60, 65 where I just can't keep it anymore. Maybe they won't let me keep it after age 65. Do you have something for me? We can invent it, and we're going to invent it right now. It's called a policy of whole life. Now, what's cool about that is you can keep this policy for how long? For your whole life. How long we keep it is the name of the policy. We design it to cover you till you die. Now, just imagine this. As an insurance company, if I'm going to guarantee that I will pay no matter when you die, I got to charge you more money. I got to charge you more money. Okay? Because when you're 80 and 85 years old, you're still going to be paying the same rate when you bought this at 30. So I have to charge enough at 30 to cover you even when you're 80. Now, I don't know if you conceptualize this or not. If you don't, just blame me. What we do in his insurance is we overcharge you while you're young so that when you are 80 and 90 and we need a lot more money, we have collected extra money so that we can insure you all the way till you're 100. That's what a whole life does. It covers you for your whole life without ever raising your rates. The rate you start at is what you'd get at the end. That's the nature of a whole life policy. So, level premium policy is called straight life or whole life. What you have on the slide, though, is not new policies. This is all whole lives. It's just how do you want to pay for it? Can I pay my policy off early? I don't want to pay, Peter, when I retire at 65. I want the policy, but I want to have paid enough in that I don't have to pay any more. Can you pay it off early? Absolutely. We call it a limited pay life. Instead of paying to 100, you just pay till you're 60 or 65. You tell us how long you want to pay for it. We'll figure out how much you put in. Now, I hope you can follow me here. If you have a 30-year mortgage and you come to your mortgage broker and say, I want to pay this off in 15 years, what will happen to your monthly payments? If you want to go from 30 to 15, you can do it. It's just math. But what happens to your payments so you can pay it off faster? Peter is just too confusing to follow with these tough questions. If you want to pay it off early, what happens to your monthly payments? Thank you, GFAT. Mick. Yeah, no problem. You can pay it off early. I'm not sure if it doubles, but whatever it is, you got to give us more money so we can pay it off early. Same thing with a limited pay life. We can limit your payments. You can pay it off early by just merely paying us more than the whole life rate. So if I have what's called a life to age 65 and my brother has a whole life, I will pay more money. Same death benefit. Okay. But when I'm 65, I'm done. Still have the insurance, but it's all paid off. My brother must continue paying until he dies. So you can get it, but anytime you improve anything, you got to pay a little bit more. If you want a piece of cheesecake and you want to put cherries on top, I'll bet you it costs you more. So you just got to pay more to get that. In fact, to the extreme, hardly ever done, but they ask about it on a test, you can actually pay your whole life off with one big check. If you have enough money, you can pay it all down. The insurance company will earn interest. Somebody said that. will earn interest on your money, and no matter when you die, they'll pay the death benefit. So this is not three different policies. That's what I want to tell you. A limited pay life is not different than a whole life. It's just a whole life paid off faster. Okay, so get clear on that. Your test could call it life to 65, life to 60, 20 pay life. It's still a whole life. It's just you're putting more money in to pay it off faster. That's all it is. Now, whole life premium payment, straight life or whole life, you make the same payment until you die. Okay. A limited pay life, you increase your payment so it can be paid off at any time 20 years, 40 years, age 65. Tell us when you want it paid off. We got guys with calculators, computers that can tell you what you need to pay fast. They can figure out your rate lickety split. Bet you haven't heard that word in a long time. Okay. Whole life premium payments. This is absolutely critical. People miss this on the test, and I say, I'm quitting teaching because I grill this into people's heads and they still miss it. I don't want any of you to miss this on your test. No matter how you pay for a whole life, the cash value of that policy equals the death benefit when you're 100. They'll say to you, you bought a life to 65. When does the cash value equal the death benefit? And 30% of the people will say, oh, age 65. No, it's a whole life. It just paid it off early, but the cash value is going to equal the death benefit at 100. Okay. That doesn't change. Cash value, we actually use words like it matures. Oh, is this Viola Davis, the award winning actress that's talking to me here? All the years I've been teaching, you're the first person that asked this question. You are actually correct. Okay. However, insurance companies changed that to 120, but most tests haven't changed. So Melissa and I teach to the test. We'll lie to you just to get you to pass the test. Most insurance companies today, it equals a cash value at 120. However, on your state, the odds are they're working with 100. How do I know the truth is? Oh, come on, just for a couple hours, you can be Viola, okay? Now, just how do you find out? Look in the text you're studying. When does the cash value equal the death benefit in Wyoming or wherever you're living? If you don't have a text or you don't want to take the time to find it, Google it. Just Google it, okay? But you want to know what's on the test. What this test is a ticket to the dance. Okay? It doesn't do anything for you. It doesn't pay you higher commissions. It doesn't guarantee you a job. But what it does is it's a ticket to the dance. Once you pass the test, you can now get involved in selling insurance. Okay? So what Melissa and I want to do is we want to get you through the test. Then you can go and learn all these side things about insurance and become a real nerd or whatever you want to do. But that's not my goal. My goal is to get you through the test. So, um, Victoria, please Google it in your state. Okay. All of you people, most states are still telling you that it matures at 100. For your purposes, it doesn't really matter. You just got to learn the right number, right? And you can get it correct. But thank you for asking that question. Ooh, here it goes again. Which policy costs the most? Whole life, 20 pay life, 30 pay life, 10 pay life. Which one costs the most today? Oh, Peter, you're giving me a headache. That's what they sell Excedrin for. Go get some. Which one's the most expensive today? All of you that answered are trying to make this a term policy. Okay? The longer you covered, the more you have to pay. That's not the way whole life works. This is how long is your mortgage good for? The shortest mortgage costs the most. The 10-pay life will be the most expensive. Why? You're paying off this whole life policy in 10 years. Man, you got to fork over some money to get that done. The least expensive is number one, because we can stretch your payments out all the way till you die. You ever borrow money for a car? And I don't know how long they'll go out now. Last time I looked, they said you can spread this out for 7 years. By then, the car will be worthless. But that payment on a 7-year car loan is lower than if I want to pay it off in 3 years. So in whole life, don't think it's term insurance. In whole life, the longer I stretch out the payments, the cheaper it is. Shouldn't say cheap, less expensive. Whole life is your least expensive, then 30, then 20, and the most expensive is 10-pay life. So people get mixed up here. Gee, I just spent time learning about term insurance, and the bigger the number, the more I pay. 20-year terms more than 10. Okay, remember I told you, put term insurance in a term insurance drawer. We're in whole life now. You're going to have a policy until the day you die. If you stretch the payments out for longer, you'll have a lower payment. So in this question, 10-pay life is the most expensive. Oh, light bulbs coming on in everyone's brain, I hope. But these are the things you got to have clear in your mind so they don't fake you out. Those people who make the test, they're not nice people. They don't just say, let's get them the simplest questions possible because I want everyone selling insurance. They're going to try to fake you out. So just try to understand what we're talking about with a whole life policy. You're going to be insured until the day you die, even if you die at 100. Okay? Term insurance, we're just covering you for a little bit of temporary time. So they're different animals, right? And we just have to be clear on the question how that works. Now, if that didn't make sense to you, please, advertisement time. Melissa Dillon, Insurance Exam Queen, sells a course, Gold Platinum courses, where she teaches all the chapters. Look at the chapter on life policies. She'll explain this. She's excellent. You can even buy my teachings through the Insurance Exam Queen on YouTube for a month at a time for $25, all of them, all chapters. Look at the life policies chapter if this is a hard one for you to keep straight. But I don't want you to mix up. Well, mix it up at your own peril. You're going to get it wrong on the test. The highest premiums, the 10-pay life. So let's just look at this summary slide. Term, temporary, for a specific period of time. It has no cash value. Whole life, permanent. I'm going to say till you die. Most tests assume the policy matures at 100, which means if you're 100 years old, they actually send you the death benefit, tax-free, saying you won. Here's you outlived us. Here's your money. But it is permanent so that when you die, you'll have the insurance. It also builds up this mysterious thing called cash value, which you don't get in whole life. I mean, you don't get it in term. So that's a good slide to take a picture of. Now we're to go on a whole other topic. Now, there's other stuff I could teach you about term and whole life, but I just like I wanted to, I just want to make sure you have some clarity and you're not getting all mixed up about the way they work. The most important elements are what I'm talking about. Now, when we go to a universal life, this is not like either of them. It's kind of, I don't want to say it because you guys are going to get mixed up because I don't explain it. But anyways, universal life has none of the guarantees of whole life. You know, whole life is guaranteed. Your cash value is guaranteed. When you buy that policy, they'll tell you what your cash value is every year, whether the market goes up or down, interest rates go up or down. That cash value is guaranteed by the insurance company to be there. That death benefit is guaranteed to be there. You set it in motion. All you need to do is keep making your payments. Okay. When we go to a universal life, What we're trying to create is a policy that you can keep until you die, but we want to give the purchaser some flexibility. By doing that, it takes away all guarantees. There are no guarantees. Cash value grows at a current interest, which can be changed by the insurance company. Now, here's what I'm going to do right now to try to make sense of this. I'm going to take slide off. I'm going to show you a chart I made just for you folks. I don't draw well. I don't write well. My charts are not as pretty as Melissa's. And this is going to be, oh, what are you talking about, Peter? So you'll have to just work with me. Let's see. First thing I want you to know, oh, it's Warren F. The universal life is known for flexible premiums. Okay. When you see flexible premiums on your test, that's code for universal life. It means literally you can pay what you want. You can skip payments, you can put in more money. We leave it up to the consumer since life isn't always predictable. It's why this policy is so popular. People say, hey, if I'm having a tough time, I'm out of work for a while, I can lower my payments and still keep my policy, perhaps. Okay. But since you can change your payments, we can't make any guarantees what will happen. What's occurring in this, let's see if I can hold this, you guys. You see my dollar signs? The dollar signs are dropped inside a bucket. It doesn't look like a bucket, but pretend it's a bucket that pays you interest. So when I buy a universal life, you tell the agent, I want to buy $100,000, and they give you options. There's target premium, there's maximum, minimum premiums. You got to pay somewhere in between to get it started. But the money goes into a bucket and they pay you interest on your money. Now, my friends, that's not life insurance. That's a savings account. Put money in, they pay you interest. There's two things that are changeable here. You can change what you pay in, and the insurance company can change the interest they pay. 1 year ago, and let's go back 2 years. 2 years ago or whatever, interest rates were very, very low. So insurance companies could only give small interest payments. Then they shot up. Now the insurance companies can pay more, but that will change over the years, up or down. So we now have two factors in this policy that are movable, right? What you pay in and what the insurance company pays you for interest. That's why we can't guarantee anything. To make this bucket insurance, you will notice on this genius chart I made, the bottom of the bucket has got a hole in it. Yeah, there's a song that says that my bucket's got a hole in it. Your universal life bucket has a hole in the bottom. And every month, the insurance company goes into your money, takes out enough to keep you insured at your age for the amount you bought. And they also take out a small administration fee. When you're young, they don't have to take out very much because we don't charge people a lot. But it's really like an annual renewable term. Every year you get older, they widen that hole a little bit. They need more money because you're getting older. And every month they'll go into that bucket and take out enough to keep you insured. Now, folks, here's the Latin caveat emptor, which means buyer beware. Buyer beware. You have to keep your bucket healthy. If that bucket runs down and they go in to insure you, now instead of 20, you're 60, and the hole is bigger, but you haven't kept the bucket healthy, there's no money in there, boom, you lose your insurance. So you got to, as a consumer, you can put in whatever you want, but you got to watch the health of your bucket because that hole at the bottom will gradually get larger. And when you get the age of wisdom, like me, it's a pretty big hole. Okay, so you want to make sure that bucket is healthy. It's not as complicated as that because you go on a computer and it'll just tell you the answer to those questions. Now, that's the way a universal life policy works. Let me go back on the slides. This one says, universal life has none of the guarantees of whole life. However, there's a minimum interest guarantee. In other words, law requires the insurance company to say, in the worst of times, we must pay you, and they got to tell you. It's usually 2% or something like that. They can never pay you less than that in your bucket. And the mortality charge, and I probably shouldn't have put this on the slide. It's not on your test. But what they charge you every year for your insurance, the insurance company can actually change that. They can't change it for you, but if the insurance company in general, and there were to be a tragedy and they pan out more deaths than expected, they have to raise the rates. They can change the rates of everyone's universal life. And what I mean by that, that's the amount they invade your policy and take out. Not on the test. You can forget I said it. I'm merely telling you, different than a whole life, which is set it, boom. What do they used to say? Set it and forget it. It's all guaranteed. A whole life's a little bit more sophisticated. The modern consumer likes the universal life because you get a count every year that tells you how much you put in, what your interest was, what the insurance charges were, and you can just see it. You can see how your policy is doing. And you can ask the insurance company, if I keep paying this, how long will it last? And they'll answer you. Or I want to make sure I have enough money to be insured till I'm 100. They'll tell you what you need to put in. It's really kind of modern times, which is why it's so popular. Pause. Folks, I feel I talked a long time and I have no idea if it made sense. Don't be shy to ask a question. That's why you're in a live class. You could watch a video and you can answer questions, not ask questions. Are we okay? Is there something you said, Peter? I didn't get some part of that. I'll be happy to try to speak to you in French or something. No, I'll try to explain it better. What do you think? Are we okay so far? I mean, for all I know, you guys could have just gone to the kitchen and get a bologna sandwich. I didn't make, but I'm insecure. But what I want you to get is understand the basics of term, renewable, convertible, temporary, whole life, cash value. You can pay it off early. Universal life is put money in a bucket. Insurance company pays you interest every month. They go in, they take out enough to keep you covered. All right, so that's what I wanted to make sure we understood. Let's see what my slides say next. So the client deposits premium into a fund that pays current interest. The insurance company deducts mortality, that's your insurance. That's a nerdy word for insurance, mortality charge from the fund. All universal life policies have a surrender charge. This is not commonly asked, but I have seen it asked on tests. That is, my friends, a penalty for early withdrawal. So you got this money in your bucket. That's really your cash value. But holy cow, in the first year, if you have decent interest, you could have more money in the bucket than what you paid in. If your insurance charge is low and your interest is high, this could be a moneymaker, right? And that's true. That's your cash value. But you can't get at it for a period of time. Insurance companies are not built by their nature of their investments to be a put and take account. I'll put it in for 3 months and take it out for Christmas presents. That money belongs in a bank. Even if I want to put it in for 6 months and put a down payment on a car, that money belongs in a bank. When you give money to an insurance company, we invest it for payments we may have to make 30 and 40 years from now when people die. So we tie the money up. Therefore, if you want all your money out early in a universal life, we can't let you have it all. There's a surrender charge or penalty for early withdrawal. It'll go away. Some policies that go away in 5 years, some 7, some 8, but the penalty goes down as the policy ages, and eventually there is no penalty. Everything in the bucket you can get your hands on. There is another product, just wanted to tell you people, that makes a surrender charge. You can't get at all your money early on. Anybody remember what product does that? Big hint, it's not life insurance. What product has a surrender charge? You can't just put it in and take it out without some kind of penalty. Anybody? This is for a master's degree, if you know this one. Not quite. I'm going in a different direction. Let me tell you where my pea brain is. Annuities. If you thank you. You are Viola. Anyways, here's the deal. If you put money into an annuity, you want to have a lifetime income. And if you say, pay it to me now, they're going to pay it to you. But you put it in and then you say, I don't think I want this annuity. Can I have all my money back? Not so. In the early years, you will pay a penalty for taking and surrendering that policy early. It goes away, but there's a surrender charge on annuities. There's a surrender charge on universal lives. Okay. Now, you people that want to talk about IRAs and stuff like that, there's a tax penalty. I'm talking about a product. You could put your IRA into gold or all kinds of places, but if you put it into an annuity, then you want to surrender it early. The actual product's going to keep some of your money. So too with the universal life. Now, I'm not going to make a big deal of this because it's not on many tests. Okay. I want you to get the big picture, and the details hopefully will come together for you. There's another thing that is on many tests. You can only do this on a universal life. Okay. Melissa says, and if Melissa says it, it's true. 80% of your questions are going to be on term and whole life. So those first two exercises I did with you, what's more expensive, stuff like that, that's your test. 80% of your questions was right there. The next ones, not very many, but the next policy with the most questions is this universal life. And here is a popular question. Only on a universal life can you take option A or option B. So let me take a drink of water and I'll explain this. So I don't know if these are your real names or not, but I'm going to pick on Sammy Hossein because I can say your name. Let's imagine that Sammy has a life insurance policy. Okay, think with me. Sammy purchased a whole life a long time ago and is insured for $100,000. But the policy is it got some years into it, and Sammy now has a cash value of 30,000. So let me say it again. 100,000 death benefit, 30,000 cash. Sad story. Get your Kleenex out. Sammy passes away. How much money is Sammy's beneficiary going to get from this whole life policy? 100,000, 30,000 cash. How much money is the beneficiary getting? I will say it again. 100,000 death benefit, 30,000 cash. Sammy goes and meets the Lord. Okay. How much money is the insurance company paying the beneficiary? Life with Diana says $100,000. So does Brittany. 100,000. You're all right, but it does trigger this question. What happened to the $30,000 of cash? That was legally Sammy's money. He could have cashed that policy out and got 30 grand. And now he dies and the insurance company pays 100. What you discover is not on the test, but it's true. That cash value is actually part of the death benefit. If Sammy had taken a $30,000 loan out and died, the family would have only gotten 70,000. So he gets the 100,000. It's what he bought. $100,000 death benefit, dies, they pay 100,000. Okay? That cash value legally Sammy's money, but it's actually part of the death benefit. Now, what if he could buy a policy that would have paid his family $130,000? Death benefit plus cash. You can actually do that if you take option B, universal life. Sammy had an option B, universal life. They would have paid the family $130,000. In fact, that was already taught to us by Jay Holmery. I'm sorry for pronunciation, but you got to admit it's not a name I see often. Said you need option B in order to get both. Bingo. You should be teaching this class. You say the simple things faster than I do. If you want both, you must buy a universal life with option B. At death, they will pay both. Fair enough? Now, I'm not talking here. Some of you people are talking about IRAs and 401ks. We're not talking about that today. We're talking about life insurance policies. Okay. That's what we're talking about. Well, go back tomorrow. You're ready. At least if you get a question of option B, you got that one. So, anyway, I want you to just be aware of this stuff, right? That's why I wanted you guys to take some notes because, in a little bit, I'm going to say goodbye. Poof, I disappear. And tomorrow, you won't remember anything unless you wrote the notes down. Okay. Option B, to be clear, the death benefit pays the death benefit plus the cash value. That's what it does. Now, I can tell you how they do it, but it's not on your test. This is what you need to know. Okay? Anybody care to know how they do it? Because if the cash value is part of your death benefit, they really can't do both. How do they do that? Not on your test. This is just so you can sit down with an insurance nerd and bore them. They purchased an increasing term rider for you. Every year, your death benefit increases by the amount of your cash. Now, what you need to know, it's not free. So option B will cost you more than option A. But you can get it, and it's not prohibitive. A lot of people really like it and buy it, okay? But you don't need to know about one-year term riders. That's never on the test. All right? Isn't this the most fun you've had since New Year's Eve? Wonderful. So, a little summary. In a universal life, this is flexible premium. If you get a question that says flexible premium, please immediately think of a universal life because whole life and terms don't have flexible premiums. Okay. Now we're going to enter into the other policies. Less important, much fewer questions on the balance of my slides. Folks, what you got to know, term, whole life, 80% of your questions. Know those two as deep as you can. Which is more expensive, which is less expensive, what's renewable, what's convertible, when does the cash value equal the death benefit, all that stuff, lock it in, okay? That's majority of your course. Understand option B on a universal life and flexible premiums, okay? That's pretty much all you got to get on a universal life. Now, there's this adjustable life, which is rarely on any test. If it is, it's one question. It's a policy that can change. And I put on the bottom of the slide the word chameleon. I don't know if you people, some of you, I'm sure, are familiar with a chameleon. A chameleon is a lizard that changes its color to its environment. My nephew owned a chameleon once. He put it in a fish container, obviously no water. And if he filled that container with brown twigs, brown leaves, brown, that chameleon was brown like the twig. You would walk in, he'd be on the twig, you'd have a hard time seeing him. Then he would change it to green. He put in all green in there, leaves, grass, things like that. You'd come in that room and you couldn't see the chameleon because he was the same color as the leaves. Chameleons are a cool little creature. But I teach you that not to get you to want to be a zookeeper, but that's all you need to know about an adjustable life. It'll change at your commands. You start off with whole life. You decide to go to medical school and you say, I can't afford the whole life now. Can I just have term? They change your policy to a term policy. You don't need to buy a new policy. You get out, you're a brain surgeon knocking down $1 million a year. Say, I can afford the whole life now. They change it back. This policy, without buying another policy, allows you to change. Rarely sold, rarely on the test. So my advice to you is don't worry about it. If you care to get it right, just remember an adjustable life is a chameleon. Just remember that one. Okay? Now we have what's called a variable life. My friends, if you pass this test and get a life license, you cannot sell a variable life until you get a securities license. So they're not going to ask you many questions. In fact, all of the questions they ask are on this one slide. They usually give you one or two variable life questions. It requires you to have a security license. Security means you can sell stocks and bonds, and life license. By selling stocks and bonds, you must be registered with the Securities and Exchange Commission and FINRA, which I don't memorize all their words. They are regulatory authorities governing the sale of securities. You must be registered with them. The cash value and the death benefit are not guaranteed, and the money goes in a separate account. Let me explain these last two. What the insurance company is going to do is they're going to allow you to turn your cash value and your death benefit over to the stock market. You will tell them, like you could in a 401k, I want to buy this fund, that fund, whatever, and they will take your money, put it in a separate account. Insurance companies don't hold this money because they don't invest in that stuff. They invest in it for you. Your cash value and your death benefit will go up when the market goes up and come down when the market comes down. So you have no idea what it'll be worth when you die or when you retire or whatever. But the people who buy this believe over time, stock market's going to really kill what an insurance company can give me. So they're attracted to a variable life. The only things you need to know about a variable life are on this slide. You might get one or two questions on it, okay? It's not guaranteed. And as Johamari, boy, I'd love to know how to say your name, but you don't have a microphone. Um, investors bear the risk. You're the one that chose that fund, okay? You can be a smart hero or you could say, wow, that's a dumb thing. But it's up to you, okay? So you can leave the money with the insurance company and the clunky old whole life. And what you got is something you absolutely know every year what your cash and death benefit are. It's guaranteed. You can go into a universal life, change the way you pay. The insurance company can adjust the interest, but they never put the money in the market. It's always going to go up to some degree, right? Or you can go into the market with a variable life. Ooh, here's a horse of a different color. Equity indexed life. Again, one question on the test if you get any. So don't, like the adjustable life, don't, these last policies I'm telling you, adjustable, uh, variable, equity indexed, small amount on the test. Your test is whole life and term. Okay, don't forget that. Equity indexed life, rather than putting the money in the market, you're going to select an index. Standard and Poor 500. I had no idea because I'm not an investment wizard. There's like 30 indexes. And you tell the insurance company, I want you to match that index. So index goes up, your cash value goes up. Here's the beauty of this thing. Market goes down, your cash value stays the same. So look at the second line. You can get market-like yields with no downside risk. And you don't need a security license to sell this. Weird. Very popular policy, by the way, but there's not much on it on the test. It behooves a very important question that's not on your test. How can you do this? How can you have market goes up, I make money, goes down, I keep all the money I made, I don't lose anything, and I don't need a securities license to sell it? This is not on the test. So if you really don't care, don't pay any attention to me for the next 30 seconds. You never own securities. The insurance company takes some of your money and they buy an option, which says 12 months from now, I can buy this indexed fund for today's price. So if it goes up, I buy it and sell it. So I never hold it, but I get the profit. Okay. Market goes down, I don't exercise the option. I just let it go. So I can get the up, I don't have the down. I have to pay for the options. Now, none of that's on the test. All you need to know on the test, equity indexed is based on some kind of index that you chose, and you can get market like, it doesn't match it exactly, but market like yields, no downside risk. Not on your test. Stay in the term and whole life arena to get. Let's see what else we got to talk about. Summary. I'm not yet. I have a couple other things after this. Those of you that are anxious to run out and watch Netflix, not quite yet. Okay. Term is temporary, no cash value. Whole life, guaranteed premium, guaranteed cash value. One other thing I'd put on there, cash value equals the death benefit at 100. Okay. Adjustable life can be changed whole life to term and back again. Universal life has flexible premiums, option A and B, minimum guarantees. Variable cash is invested in secure, has no guarantees. So what I'm going to do right now is I'm going to go back one slide. If you want a summary of what I've taught you, take these 2 slides as a very basic summary. Take a picture of, or whatever, screenshot or whatever, however you want to do it. Term is temporary, whole life, adjustable life. 5, 4, 3, 2, 1. Page 2, universal has flexible premiums, option A and B, minimum guarantee. Variable life is invested in securities. Those are it's a summary. Wait a minute, just a second here. I got to do this. I've been talking to you guys for 67 minutes and I put it all on 2 slides. Wow. What a waste of time, Peter. All right. Anyways, that's the way it is. Let's stop goofing around. Let's talk about another policy. A joint life policy is built like a whole life. So don't worry about, is it like a universal life? Is it like a variable life? No, it's like a whole life. The only thing about this policy is you can insure more than one person on a policy that has one death benefit. One death benefit. So if me and the lovely Mrs. Lemieux decide we need life insurance, but at our advanced ages, it's a lot of money. So we don't want to buy 2 policies. We get attracted to this joint life because both of us are insured. It only pays one death benefit. It pays the first death benefit, which is what we need. If I die, I want the lovely Mrs. Lemieux to have money. If she dies, she's so crazy about me, she wants me to have money. Okay. And then there's no death benefit after because we don't care about our kids. Okay. So anyway, it's a perfect policy for those type of people. 2 policies. I'm only got one death benefit. It's more expensive than one policy, but it's less than 2 because it only has one death benefit. Okay. That's a joint life policy. There is another one that you could get asked about called survivorship life. It's a joint life policy. You can put more than one person on. One death benefit difference. This pays at the last death. And here's how you're going to remember this. And you're all smart people. Some people left. They're missing this great clue I'm going to tell you. You all know about the TV show Survivor. They throw a whole bunch of people on an island, and the one who's left at the end is the winner. Survivor is the last one. A survivorship policy pays at last death. So if my wife and I chose this policy and I died, she gets nothing. But when she dies, the kids get the money, and vice versa. One death benefit at second death. It's really designed to help the family pay like estate taxes or something. There's no estate taxes when you're married, but once the second person dies, the government swoops in. This policy is very good. You're going to remember it by the show Survivor, okay? Last death, joint life, first death. All right. Um, this is a summary of the survivorship life, more than one life. Like a joint life, the price is the average age of the two people. It's an average age. They don't take the oldest one or the youngest one, they average it. One death, remember the name survivor. You got to know a little bit about group life. Again, these are all minor issues, folks. Term, whole life, little UL, universal life, you're talking about 85, 80% of your test. Group life, group has to be formed for a reason other than buying insurance. You have to have a reason for existing other than just go buy insurance. The sponsor gets the only policy. There's one policy in group insurance called a master policy. It would go to like the employer who bought the plan. The insureds don't get policies, they get certificates. And the insurance company uses group underwriting, which is code for we don't ask any health questions. We determine our rate by the size and age of the group. We know some people are going to be sick, some are going to be healthy. We don't ask any health questions. That's what group underwriting means. Group conversion. This isn't hard for the brilliant class that I'm teaching today. What we're going to say is if you leave the group and you want to keep your insurance, you can convert it to whole life. It'll be expensive, but no health questions asked. If you're leaving the group to go home into hospice to die, you'd want to keep the insurance and you can do it with a conversion privilege. Okay, this is the question I missed. Thank you. So the K3C certificate, the employees receive certificates. Master policies only one goes to the person who bought the policy. You only missed by 1 point. You're good to go. Okay, folks, this is really the key things you need to remember about group insurance. Okay, what conversion means. It means the same thing as going from term to whole life. Now, for group life insurance, to get a conversion privilege, you must have been on a group for 5 years. I was careful to say group life insurance, different than converting group health insurance. It requires 5 years to keep the life insurance. There I am. Like it or not, that's how you find me. peter.lemieux@cox.net. Let me take this off. And here I am in all my glory and splendor. I want to thank all of you for coming. Okay. Please use Insurance Exam Queen to help you pass the test. Melissa's got really inexpensive packages where she'll teach every chapter you need to know: life, health, property and casualty. She's a genius. I also have a course available when you go on YouTube, Insurance Exam Queen, where you can purchase all the life and health chapters taught by me by paying $25 a month. Keep it as long as you need, then drop it. So those are all available. We're on here for free, so we got to give you an ad for ourselves. Both Melissa and I have for many years helped tons of people pass this test. Every day we get emails from people saying thank you. And that's what we do. So I want to thank you guys for coming. However, if you have a question that wasn't answered or I said something that confused you, write it on the chat box. I'll be happy to stay an extra couple minutes and help you out. For the rest of you, thank you. Enjoy your evening. Look for future classes. My name's Peter Lemieux, and it's been a pleasure going through this with you. Anybody else got anything for me? Tracy, North Carolina. Knock it out of the park. You got my email? Send me a note, and tell me you passed. If you didn't pass, send me your test grade. We'll figure out how to help you, okay? But you're gonna pass. Everybody passes. Life with Diane had passed PNC because of this. Preach it from the hills. Well, anyway, been a lot of fun for me. I hope you guys learned a few things and makes you better prepared for your test. Let us know how we can help you at the Insurance Exam Queen. I'm Peter Lemieux. Thanks a lot, guys. Have a great evening. Viola, you're going to pass. Good night.